Okay, so this time you've given us quite a bit to dig into
Yeah.
when it comes to how companies report their financials,
Absolutely.
especially when we're talking about groups of companies.
Right.
We've got IAS 27, which is all about a company's separate financial statements.
Mm-hmm.
Then we have IFRS 10, which dives into the whole world of consolidated financial statements.
Yeah.
We're going deep into how and when companies have to combine their financials and all the little details that go along with that.
Exactly. And the goal here is to really distill the key takeaways from all of these sources
Right.
without, overwhelming anyone.
Yeah, because there's a lot here.
Yeah.
So I think one of the things that I'm finding most interesting is this idea that a company can actually have control over another company, even if they don't own most of the shares.
Oh, yeah, that's a big one.
Like, how does that even work?
It's more common than you might think.
And then the other thing that kind of blew my mind is how the exact same transaction can be accounted for in totally different ways,
Oh, yeah.
depending on whether you're looking at the consolidated statements for the whole group or the individual company's own statements.
Right, because the perspective changes.
Yeah, so what are the implications of that for, actually understanding a company's financial picture?
Yeah, that's a really important point.
So, okay, let's start with the basics.
Okay.
What exactly are consolidated financial statements?
Okay, so consolidated financial statements are basically like a snapshot of the financial performance and position of a whole group of companies.
Mm-hmm.
It's like taking a parent company and all of its subsidiaries and treating them like one big economic unit. It's kind of like, if you were looking at the finances of a whole family instead of each individual person in the family.
Yeah, like the whole household budget versus like my personal spending.
Exactly.
Okay, so we keep hearing about this parent company and its subsidiaries.
Right.
So what exactly defines those?
So according to both IFRS 10 and IAS 27,
Yeah.
a parent company is basically any entity that controls one or more other entities.
Okay,
And those other entities are its subsidiaries.
gotcha.
Now, what's really interesting is that these subsidiaries can be in totally different businesses.
Really?
Yeah, like you could have a parent company that's like a manufacturing company,
Mm-hmm.
but one of its subsidiaries could be a retail company that sells the products that the parent makes.
Okay.
But they're all brought together in the consolidated financial statements.
Interesting. So even though they might have totally different operations,
Right.
they're all considered as one for financial reporting purposes.
Exactly.
Okay, so then what about this term that keeps popping up, non-controlling interest?
Yes, non-controlling interest. So that basically refers to the part of a subsidiary's ownership that isn't owned by the parent company.
Okay.
So let's say a parent company owns 80% of a subsidiary.
Mm-hmm.
Well, that other 20%, that's the non-controlling interest.
Okay.
And it has to be shown separately in the consolidated statements
Why is that?
because it represents the ownership stake of other people who aren't part of the parent company.
Right, like other investors or something?
Exactly. Other investors or maybe even like the original founders of that subsidiary who
Yeah.
held on to some shares.
That makes sense.
Yeah.
So we're kind of taking all these separate pieces
Yeah.
and smushing them together into one.
Mm-hmm.
But how do we decide which companies need to be consolidated in the first place?
That's a great question. And that's where the control model comes in.
Okay.
It's this really important concept in IFRS 10
Okay.
that helps us determine if an investor has to consolidate an investee.
So it's not just about ownership then?
Not necessarily,
Oh.
no.
Okay.
There are actually 3 key elements that all need to be present for consolidation to be required.
Okay, hit me with those 3 elements.
All right, so first, the investor has to have power over the investee.
Okay.
Second, the investor has to be exposed to or have rights to variable returns from their involvement with the investee.
Okay, so they have to have some skin in the game, basically.
Exactly. They need to benefit or be hurt by how the investee performs.
Got it. What's the third one?
And third, the investor has to be able to use their power to actually affect the amount of those returns.
Okay, so it's not just about having power in theory.
Right.
It's about being able to actually use that power.
Exactly. It's about having influence over the things that really drive the investee's performance.
Okay, so let's dig into that first element a little more.
Okay.
This whole power over the investee thing.
Yeah.
What exactly does that mean?
So power in this context means having the ability to direct the relevant activities of the investee.
Yeah, relevant activities.
Right. So according to IFRS 10, Those are the activities that significantly affect the investee's returns.
Okay, so we're not talking about like every single decision the company makes?
No. It's more about the big decisions.
Right.
The ones that really drive the investee's profits or losses.
Got it.
It's like having the ability to decide what the key players in that company do.
Okay, so it's about having control over the things that really matter.
Exactly.
Okay. And IFRS 10 gives us a really interesting example of this whole concept.
It does.
With this investment fund.
Yeah, the investment fund example.
Could you walk us through that?
Yeah, absolutely. So imagine you have this investment fund that's financed partly by debt from one investor and partly by equity from several other investors.
Okay.
Now, one of those equity investors also happens to be the asset manager for the fund.
Okay, so they're wearing two hats.
Exactly. They're both an investor, and they're managing the fund's investments.
Got it.
And let's say they hold like 30% of the equity.
Okay.
Now, the question is, who actually controls this fund?
Right, because we've got the debt investor, we've got the equity investors, and then we've got this one investor who's also the asset manager.
Exactly. So to figure that out, we have to look at what the relevant activity is.
And in this case, what would that be?
In this case, it's managing the investment portfolio.
Okay, makes sense.
Because that's the activity that exposes the fund to market risk and ultimately determines its returns.
Right, like if they pick bad investments, the fund's going to lose money.
Exactly.
So who has the power to direct that activity?
Well, it could be the asset manager because they're the ones with the expertise, but it could also be the debt investor if certain conditions are met.
Like what kind of conditions?
Well, like if the value of the investments drops significantly, the debt investor might have the right to step in and take over.
So even though they don't directly manage the investments,
right,
they could still have control in certain situations.
Exactly.
Wow, this is way more complicated than just looking at who owns the most shares.
It is. It's really about understanding the power dynamics within the investee.
Yeah. And like you said, sometimes a seemingly small stake can actually give an investor a lot of influence.
Absolutely.
Okay. So IFRS 10 also talks about these things called structured entities.
Right.
Can you explain what those are?
So structured entities are basically entities that are set up with very specific legal and financial structures.
Okay.
Often they're designed to achieve a particular purpose, like isolating certain assets or liabilities.
Got it.
Now, you might think that because of their very structured nature, they don't really have any relevant activities, like they just kind of operate on autopilot. But IFRS 10 points out that that's rarely the case.
Oh, really?
Yeah, in reality, very few structured entities truly have no relevant activities at all.
So there are almost always decisions being made that affect their returns.
Almost always, yeah.
Okay. So even if a structured entity seems like it's just running on its own,
Right.
someone still probably has control over it?
Most likely, yes. And if there genuinely are no relevant activities, then no single investor would have control.
And what would happen in that situation?
Well, then consolidation wouldn't be required.
Even if that investor was the one who created the entity.
Even then, yeah.
Wow. Okay, so we've talked about how control isn't just about ownership.
Right.
But you also mentioned earlier that control can exist even without majority ownership.
Exactly.
Like even if you own less than 50% of the shares.
Yeah.
So how does that work?
That's where this concept of de facto control comes into play.
Okay, de facto control sounds kind of ominous.
It kind of is. It basically means that you have the practical ability to direct the relevant activities of an investee, even if you don't hold a majority of the voting rights.
Okay, so it's like having control in practice,
Ex
even if you don't have control on paper.
Precisely. And IFRS 10 gives us some really great examples to illustrate this.
Okay, I'm all ears.
Okay, so example 5 talks about this scenario where investor A owns 40% of the voting rights in a company. Now, there are 12 other investors, each holding only 5%.
Okay, so investor A is the biggest shareholder, but they still don't have a majority.
Right. But here's the catch.
What's that?
There's a shareholder agreement in place that gives investor A the right to appoint, remove, and set the compensation for the entire management team.
Oh, wow, so they control who's running the company.
Exactly. And since a management team is responsible for directing the relevant activities, investor A is considered to have control.
Even though they don't own most of the shares.
Even though, yeah, it's all about that power to direct the key decisions.
That's pretty wild.
It is, isn't it? And what's even more interesting is that it doesn't matter if they actually exercise that right or not.
Really?
Yeah. Just having the potential to do so is enough to establish control.
Okay, so that contractual power over management can be more important than the actual number of shares you own.
Absolutely.
Okay, so what's another example of de facto control?
Okay, so example 8 paints a slightly different picture. In this scenario, you have an investor who holds 35% of the voting rights.
Okay.
There are 3 other shareholders who have 5% each,
Okay.
and the remaining 50% is spread out among a whole bunch of small shareholders.
So it's a pretty fragmented ownership structure.
Very much so.
Okay.
And importantly, there are no agreements among these smaller shareholders to act together.
Right, so they're all acting independently.
Exactly.
Yeah. Okay.
Now, decisions about the relevant activities require a majority vote, and historically around 75% of the voting rights have been cast at shareholder meetings.
Okay.
So in this case, even though our investor has a sizable chunk of the shares, they don't actually have the practical ability to direct the relevant activities.
Why not?
Because those other shareholders are actively participating and voting independently.
Oh, I see. So even though the investors' votes might have lined up with a majority in the past,
Right.
there's no guarantee that that will always be the case.
Exactly. And that lack of predictability means they don't have de facto control.
Okay, so it's not just about the potential for control.
Yeah.
It's about the real-world dynamics of how the shareholders actually behave.
Precisely.
Gotcha.
So the key takeaway here is that de facto control is all about that practical ability to direct relevant activities, and that can come from things like contractual rights or the way other shareholders are dispersed.
Okay, that makes sense.
Yeah.
Now, you also mentioned this thing called potential voting rights earlier.
Yes, potential voting rights.
When do those come into play when we're trying to figure out who controls a company?
So potential voting rights are things like options to acquire shares.
Okay.
Or convertible instruments.
Got it.
Basically, anything that could give an investor more voting power in the future.
Okay.
Now, these potential voting rights are only considered in the control assessment if they are substantive.
Okay, substantive. What does that mean?
It means that the investor has the current practical ability to exercise those rights when decisions about the relevant activities are being made.
So it's not just about having the right in theory.
Right.
It's about being able to actually use it.
Exactly.
Right.
Like if an investor has an option to buy a bunch of shares, but the exercise price is so high that it's basically impossible for them to do so, then those potential voting rights wouldn't really matter.
Right, because they can't realistically exercise them.
Exactly.
Okay, this whole control thing is definitely more complex than I initially thought.
Oh, it can be very nuanced.
So we've talked about when a company might need to consolidate another company.
Right.
But are there any situations where they don't have to do that?
Yeah, actually, IAS 27 outlines a few specific exceptions where a parent company isn't required to present consolidated financial statements.
Okay, so under what circumstances could a company get a pass on consolidating?
Well, one exception is if the parent company's debt or equity instruments aren't publicly traded.
Okay.
Another is if the parent hasn't filed its financial reports with a regulatory body to issue securities publicly.
Got it.
And another exception is if the ultimate parent company,
or any intermediate parent company does produce consolidated statements, and those statements are publicly available.
So basically, if a smaller private company is part of a bigger group,
right,
and that bigger group is already consolidating everything,
exactly,
then the smaller company might not have to do it themselves.
Yeah, that's the general idea.
Okay, that makes sense from a practical standpoint.
It does.
So let's shift gears a little bit now.
Okay.
And talk about what happens after we've figured out which companies need to be consolidated.
Right.
How do we deal with the fact that different companies within a group might have different financial year ends?
Oh, that's a good question.
And how do we actually account for transactions between these companies?
Right. So both IFRS 10 and IAS 27 are pretty clear on this.
Okay.
Ideally, the financial statements of the parent and all its subsidiaries should be prepared using the same reporting date.
So everyone's on the same page.
Exactly.
Okay.
But if a subsidiary has a different financial year end,
then adjustments need to be made to their statements to align them with the parent's reporting date.
so we're basically making it look like everyone's reporting at the same time.
Exactly.
But what if it's just not practical to do that?
Well, the standards do recognize that there might be situations where it's really difficult to make those adjustments.
Okay.
But only if the parent company has made every reasonable effort to do so.
So they can't just be lazy about it.
No. They have to demonstrate that they really tried their best.
Got it.
And even then, there are some limits.
Like what?
So the difference between the parents and the subsidiaries' reporting dates can't be more than 3 months.
Okay.
And that difference has to be consistent from one reporting period to the next.
So they can't keep changing it.
Right.
So basically, if they can't align the dates completely, they can use the subsidiary's most recent statements.
Yes.
But they have to adjust them for any big transactions or events that happen between the two reporting dates.
Precisely.
Okay. Consistency in making adjustments for any significant changes seem to be the key here.
Absolutely.
So what about when we look at the profit or loss of the whole consolidated group?
Right.
How do we split that up between the parent company's owners and the non-controlling interests?
So the profit or loss, as well as each component of other comprehensive income.
And what's other comprehensive income again?
That's basically income and expenses that aren't recognized in profit or loss.
Okay, got it.
So all of that has to be attributed to both the owners of the parent company and to the non-controlling interests.
Okay.
And here's an important point from IFRS 10.
What's that?
That allocation to non-controlling interests is made even if it results in them having a deficit balance.
Wait, so even if the subsidiary is losing money and the non-controlling interest share of the equity goes negative, it's still recognized in the consolidated statements.
Exactly.
Huh. That's interesting.
It is, isn't it?
Okay, so then what happens if the parent company's ownership percentage in a subsidiary changes,
Okay.
but they still keep control?
Like if they buy more shares.
Exactly.
So those types of changes where control doesn't change hands are treated as equity transactions with the owners of the parent company.
Okay.
Basically, the difference between how much the non-controlling interests are adjusted and the fair value of the consideration paid or received, that difference is recognized directly in equity.
So it doesn't affect the reported profit or loss?
No, it's seen as a transaction between the owners.
Okay, I'm following you.
Good.
So we've covered a lot of ground here.
We have.
But consolidated financial statements aren't just about the numbers themselves, right?
No, they're not.
There's also a whole lot of disclosures that are required.
Absolutely.
So what's the purpose of all these disclosures?
Well, IFRS 12, which specifically deals with disclosures about interests in other entities.
Okay.
It says that the main goal is to help users of the financial statements understand the nature of the risks associated with the company's interests in other entities.
Okay, so it's about transparency.
Exactly.
And helping investors and other stakeholders make informed decisions.
Precisely.
What kind of specific disclosures are we talking about here?
Well, for consolidated structured entities, there are some extra requirements.
Like what?
Well, investors have to disclose the terms of any agreements that could require them or their subsidiaries to provide financial support to the consolidated structured entity.
Okay, so if there's any chance they might have to bail out the entity, they have to tell people about it.
And they also have to describe any events or circumstances that could expose them to potential losses.
Okay, so it's all about being upfront about the risks.
Absolutely.
What about disclosures for unconsolidated structured entities?
So for those companies have to disclose how they determined that they sponsored the entity, how much income they've received from it, and the carrying amount of any assets they've transferred to it.
Got it. And what if they've provided support to an unconsolidated structured entity, even though they weren't contractually obligated to do so?
They have to disclose that too.
Okay, so transparency is really the name of the game here.
It really is, especially when it comes to these more complex structures.
Right, so we've talked a lot about consolidated statements.
We have.
But let's switch gears now and talk about separate financial statements.
Okay.
IAS 27 covers these. And we also have this discussion paper that brings up some really interesting points.
Yeah, it does.
So what's the point of having separate financial statements if we already have the consolidated statements that show the big picture?
That's a great question, and the discussion paper really dives into that.
Okay.
So separate financial statements are prepared by a parent company or an investor and an associate or a venturer in a jointly controlled entity. And they're presented in addition to their consolidated statements. Now, in these separate statements, the investments are accounted for based on the investor's direct equity interest, rather than reflecting the investee's underlying results and assets.
So it's a different perspective.
Exactly. It's looking at the investment from the investor's individual standpoint. And the discussion paper highlights that these separate statements are often legally required.
Really?
Yeah. And they're super useful for a lot of different people.
Like who?
Well, like individual equity investors, debt providers, regulators, tax authorities.
Okay, so a pretty wide range of stakeholders.
Yeah, basically anyone who's making decisions about that specific legal entity,
Got it.
they need that separate view to understand the entity's own financial health.
So while the consolidated statements give us that overall picture of the group,
Right.
the separate statements provide crucial information about the individual company,
Exactly.
like its ability to pay dividends or repay its debts, its compliance with local regulations, and its standalone financial position.
All of that.
Okay, so how are investments in subsidiaries, joint ventures, and associates actually accounted for in these separate statements?
So IAS 27 gives companies a choice here.
Okay.
They can either account for those investments at cost, or they can use IFRS 9.
And what does IFRS 9 cover?
IFRS 9 deals with financial instruments.
Okay.
So it's a more complex approach.
Gotcha.
But the discussion paper points out a bit of a snag with the cost method.
What's that?
IAS 27 doesn't really give us specific guidance on how to deal with things like transaction costs.
Okay, transaction costs.
Right, those are the costs incurred when acquiring the investment.
Right, like legal fees or brokerage commission.
Exactly.
Oh.
And it also doesn't give clear guidance on how to handle contingent consideration.
And contingent consideration is?
That's basically an extra payment that might be made.
Okay.
Depending on certain future events.
Okay, so like an earn-out provision.
Exactly.
Okay.
So the paper suggests that these transaction costs should really be included as part of the initial cost of the investment.
That makes sense.
Yeah, and it also suggests that contingent consideration should be factored in when determining the initial value of the investment and any subsequent adjustments.
Okay, so it's about making sure the cost of acquiring the investment is fully reflected.
Precisely.
But it sounds like there's some room for interpretation there.
There is, yeah, and that can lead to inconsistencies in how companies actually apply the standard.
Right, because different companies might make different judgments.
Exactly.
Okay, so what about business combinations that happen between companies that are all under the same ultimate control?
Yes, common control transactions.
Right. IFRS 3, which deals with business combinations, it doesn't apply to those.
No, it doesn't.
So how are they accounted for in separate financial statements?
So this is another area where the discussion paper highlights a need for more clarity and where different approaches are seen in practice.
So what are some of the ways these transactions are handled?
Well, one approach is to use the carrying amounts of the assets and liabilities as they were recorded in the consolidated financial statements.
So basically carrying over the consolidated number.
So essentially, yeah. Another approach is to carry forward the pre-combination carrying amounts from the separate financial statements of both entities.
So sticking with the individual company's numbers.
Right.
Okay.
Now, it's important to understand that these intragroup restructurings, they don't actually change the overall financials of the consolidated group.
Right, because it's all within the same family, so to speak.
Exactly.
Ooh.
But they can have a big impact on the separate financials of the individual companies.
That makes sense.
Yeah. And the paper also talks about how the users of consolidated and separate statements might have different information needs in these situations.
Can you give an example?
Sure. Like if a lender is considering giving a loan to a specific company within a group, they're going to be really interested in that company's post-merger liquidity and solvency. And that's information they'd get from the separate financial statements.
Right, because the consolidated statements wouldn't show that level of detail.
Exactly.
Okay, so it sounds like there's still some debate.
There is.
And a lack of very specific rules
Yeah.
when it comes to accounting for separate financial statements.
It's an evolving area.
Especially for transactions that happen within the same group.
Definitely.
Okay, so let's talk about the past SFR case studies ebook.
All right.
How does that resource help us understand all this stuff we've been talking about?
So the ebook is great because it takes all these theoretical concepts and shows us how they actually play out in real-world situations.
Okay, so it's like a bridge between theory and practice.
Exactly.
Does it have specific cases on consolidated and separate statements?
It does, yeah. So there's a dedicated case study that focuses specifically on IFRS 10.
Oh, cool.
And walks you through how to apply the control model step by step.
That sounds really helpful.
It is, yeah. And while there isn't a standalone case study just on IAS 27, the principles of accounting for investments in separate statements are woven into a lot of the other cases.
Okay, so it's still covered, just not in a dedicated case.
Right.
What other topics does the ebook cover?
Well, it's got cases on investments in subsidiaries, related party disclosures, which is covered by IAS 24.
Okay.
And even IFRS 3, which deals with business combinations.
Got it.
So it really gives you a broad view of how these standards are applied in different contexts.
And does the ebook actually show us the numbers and the calculations and everything?
It does, yeah. It goes into quite a bit of detail.
So it's not just high-level concepts?
No. You get to see the nitty-gritty of how the accounting works.
Awesome. So it sounds like a really practical way to get a deeper understanding.
It is, for sure.
Well, we've definitely gone deep into the world of consolidated and separate financial statements today.
We have.
It's been quite a journey.
It has.
So let's recap some of the key takeaways for everyone listening.
Okay.
First, consolidation is all about presenting a group of companies that are under common control, as if they were one single entity.
Right. It's about that economic reality.
And it's important to remember that control isn't always just about who owns the most shares.
Yeah, exactly.
There are a lot of other factors that can come into play.
Yeah, like those contractual arrangements we talked about.
Right, and the way other shareholders are dispersed, and even potential voting rights.
All of that.
And we've also seen how the rules for determining control can be pretty complex.
They can.
Especially when you're dealing with things like structured entities.
Right.
Or less than majority ownership.
Definitely.
So it often requires careful judgment to figure out who's really in charge.
Absolutely.
And then we talked about how the accounting for transactions within a group can look very different depending on whether you're looking at the consolidated statements or the separate statements of the individual companies.
And that's a key point because it means that the same transaction could be presented in different ways depending on the perspective you're taking.
Exactly. And those different perspectives are meant to serve the needs of different users of the financial statements.
Precisely.
Okay, so I have a question for everyone listening.
Okay, shoot.
Given all this complexity and the fact that there's so much judgment involved in figuring out who controls who and how transactions are accounted for, what are the implications for how we actually interpret a company's financial health and performance?
That's a really great question.
It really makes you think about how those different views of the same transaction can paint very different pictures.
They can.
And how important it is to understand the context.
Absolutely.
So for anyone who